Hi, this is Professor Barati for Business Finance, our Saturday class. And Saturday we'll be going over basically the chapter 2, which is in Canvas, which I basically found some good PowerPoint presentations that cover all the topics from that chapter. Now, this is not the text that we're using, but I like this a lot better. So I'm going to be lecturing from here, and you'll also have a copy of this video. So, as part of our learning in the first week, we're just going to review accounting because it's basically the language of business and finance. So the more we understand accounting and what the different financial statements mean and are telling us, the more fun we'll have with finance. I always say that accountants get to write the story, but finance people get to tell the story. And there's a really different set of skills for the two. So when you're writing the story, you're really concerned about sweating the small stuff, debits and credits, detail, a lot of spreadsheets, making sure things balance, and so on. But once the financial statements are complete, the real action begins when the financial part of management takes over and starts to interpret, analyze, and communicate the results to management and external users. You're going to learn the tools to do this. But one of the things you're not really going to learn in this class is how to write. And that's where your own writing skills and style becomes an important part of your success. The better you can write, the better you can communicate to your management team and to external users. So with that said, a quick review of accounting. Now there are 41 slides here. I will go through them very quickly. And so our learning objectives. We're going to learn about the income statement, how it measures profitability, the price-earnings ratio, relative valuation of earnings, balance sheet which shows assets and financings of assets with debt and equity. So a balance sheet is essentially our assets, liabilities, and equity. Then we have a statement of cash flows indicating change in the firm's cash position, how we get from one point in cash to another point in cash with both the income statement and the balance sheet. So the statement of cash flow uses both income statement and balance sheet information to figure out how cash was used and how cash was created in the company. The statement of cash flow is a very underappreciated statement, and it's not emphasized enough. But when it comes to analyzing financial information, the cash flow statement, I think, is very important because, again, it basically reconciles the income statement and balance sheet into a cash flow. We're going to learn about depreciation and tax reductions that help improve cash flow. The reason why we study depreciation and a lot of tax benefits is because when we're determining cash flow, many expenses such as depreciation and tax impact on those expenses will be used to determine cash flow. The three basic types of financial statements: the income statement, which shows profitability; statement of retained earnings, balance sheet, which shows our assets, liabilities, and retained earnings; and statement of cash flow, which I just explained. The income statement. covers a defined time period. It could be for a month. Most companies produce monthly income statements. It could be done quarterly. It could be done annually. It is a profit and loss, which basically tells the reader how much money a company made. So here is an example of a basic income statement. Our sales less our cost of goods sold. These are the expenses that produce the sales, equals gross profit. A gross profit is a very important measure in the business world and in income statement. Gross profit is the money we earned after producing sales that's left over to pay for selling and administrative expense and interest expense and so on. Gross profit will also be a percent of sales. So if you take gross profit and divide it by sales, in many cases you get a percent. That percent is a very important percent to know in business, and we will drill on that a lot in class. The gross profit basically is a percent. It tells you how much money you're earning on your sales. So for example, for every dollar, this particular case, 500 over 20 over 2 million is 25%. So in this case, for every dollar we sell, Kramer Corporation earns 25 cents of gross profit on that dollar. So it's an important metric. Then we have our selling administrative expenses below the gross profit line. These are operating expenses. Depreciation expense, which many of you who have taken cost accounting knows that in a factory, when related to factories and machinery, depreciation expense can very much be in the cost of goods sold section. So, gross profit less selling and administrative expense less depreciation expense equals operating profit. Also a very important key metric. Less interest expense equals earnings before taxes. Then we have a tax rate. We apply our taxes, earning after taxes. So earnings after taxes, which is really our net income. We subtract preferred stock dividends, becomes earnings available to common stock shareholders, and then from there we compute our earnings per share. Sales minus cost of goods sold equals gross profit. Gross profit minus expenses minus depreciation equals earnings before interest and taxes, or EBIT, or operating income. EBIT minus interest equals earnings before taxes. EBIT minus taxes equals earnings after taxes. The concept of return on capital is very important. Return on capital is basically your net income as a numerator divided by a denominator. That denominator is going to be your capital. And capital is essentially defined as the liabilities and the equity that is used to finance your assets. Assets generate operations. Assets are used to generate sales. Assets are used to generate income and cash flow. Okay, so we're going to learn about all the ratios that measure how well we do that, how well we generate cash with our assets, how well we turn over our assets to generate sales and income and so on. However, those assets had to come from capital. We borrow money and we take money from investors. Debt plus equity is capital. The primary sources of capital are bondholders, which is a debt, and in receipt they get interest. Preferred stockholders, which is equity, they get dividends. Common stockholders, which is equity, they get dividends. Earnings per share is the number of outstanding shares. And basically number of earnings per share and divided by the net income. A statement of retained earnings indicates how we dispose of that earnings. In accounting, earnings will eventually make their way into the retained earnings section of the balance sheet, which is equity. The retained earnings account in the balance sheet is simply an account where net income goes to rest. So all the net income earned by a company over the years essentially ends up in this account. So it's cumulative. But for every statement, we start with our beginning balance. We add in earnings available to stockholders. Deduct cash dividends, because that comes out of retained earnings. Dividends are not an expense on an income statement. They are a reduction of equity. So cash dividends are declared. They come out of retained earnings, and we get an ending balance. So every financial statement shows how retained earnings went up or down. Did it go up because of earnings for common stockholders from our income statement? Did we declare dividends and reduce our retained earnings? And so on. Price-earnings ratio. The PE ratio is a multiplier applied to earnings per share. So it's the price of the stock divided by the earnings per share of that company. And it's a metric that investors and analysts use to analyze if a stock is relatively valued, cheap, expensive, and so on. The higher the PE, meaning that the price of the stock is growing at a greater rate than the earnings, basically as that PE ratio goes up, the stock is indicating the stock is more expensive. Factors that influence the PE ratio are earnings and sales growth, which would affect the denominator, risk and volatility, debt equity structure, dividend payment policy, and quality of management. Earnings per share allows relative market value comparison of many companies. Essentially tells you how expensive or cheap the stock you're looking at is. Firms with high expected returns have higher PEs. So investors are willing to pay more for that company's stock. Here's a table of PE ratios for different companies over the years. So if you take Bank of America, DD means the company had a deficit. It had a negative earnings, therefore there was no PE ratio. A numerator divided by zero denominator is 0. However, in 1998, the Bank of America came back, and it basically, in 2001, it went to 10, a multiple 10. 2010, it had a big spike. Unless I had a bad earnings season that year. In 2013, again, basically came back to its historical norm. And then in 2015, it had a spike again. You can see Cisco was very expensive as a stock in 1994. People were willing to pay a multiple of 41 times Cisco's earnings. Today, they're only willing to pay 19 times Cisco's earnings, which means that the glory days are over as far as stock investments in Cisco. But you might not have as much risk as well. Ford again had a rough year in 2010, has a very low PE, which means that the price is much closer to the earnings of the company and earnings expectations. So you can see there's a lot of volatility in the changings of the price PE ratio of many different companies. Why is the income statement limited? Income gained or lost during a given period is verifiable transaction. Stockholders may perceive much smaller gain or loss from actual day-to-day operations. Flexibility in reporting transactions can result in differing measurements of income gain from similar events at the end of a time period. Another limitation of income statement, which is not mentioned here, is people tend to think of income statements as exact science, that it's because it's numbers and everything balances, it's perfect. It is very imperfect. Income statements have a lot of estimates in them. Companies estimate accruals. They estimate contingencies on lawsuits that are pending, what the impact is. They estimate reserves on bad debt. They will estimate basically warranty reserves when they have to warranty their products. They don't know exactly how much warranty expense they're going to have over the next 12 months, but through historical analysis, they'll say, well, 5% of our sales usually turn out to be warranty issues. So they'll use that as a method, okay? But it could be 1%, 8%, and so on. This creates a lot of volatility in the income statement, so it is not an exact science. The balance sheet. It basically tells us what a firm owns and how assets are financed. It basically delineates or separates the firm's holdings and obligations. It's a snapshot of the company's financial position at a given time. One of the drawbacks of a balance sheet is everything's based on cost rather than current market value. And so costs, things that we bought 10 years ago, might not be as valuable as they are today. We might be taking depreciation, but they might be less valuable in the marketplace and so on. How do we interpret balance sheets? The balance sheet is all about liquidity. So what is liquidity? Liquidity is a company's ability to turn assets into cash. It's the ability of its assets to turn into cash. The faster, more frequent an asset can turn into cash, the higher up it's on the balance sheet hierarchy as far as assets. So assets are ranked by liquidity, meaning the most or the more liquid an asset, the earlier it is on the balance sheet. As liabilities are also classified based on liquidity. The more current, meaning 12 months, 0 to 12 months, if companies have obligations of 12 months or less, those liabilities on the balance sheet will be classified as current. The more long-term liabilities, obligations that we have to pay a year or more out, are considered long-term liabilities and are below the current liabilities. So, but liabilities are basically listed by order of the obligation time. So less than a year gets listed first on the balance sheet, and then after a year, those liabilities get listed after. So current assets are items that can be converted into cash within 1 year. Current assets will be cash, marketable securities, accounts receivable, less allowance for bad debt, because that's an estimate of receivables we won't collect, and inventory. These are the typical current assets, and they're current because what the balance sheet is saying that 1 year or less, these assets will turn into cash. Accounts receivable, once collected, becomes a cash. Inventory becomes cash through the income statement. As we make products or services, our inventory basically is used to generate those products or make those products. Those products get sold. Thus, as inventory is reduced because we're selling it, it turns into cash. So it's a cycle. Other prepaid item expenses represent future expense items that we already paid for. For example, if you pay for your 12-month insurance policy in January, you don't expense that whole insurance policy in that month of January. It is what's considered a period cost, and therefore it gets expensed each month for 1/12 of the month. So 1/12 of each month is using 1/12 of the insurance policies being used on a monthly basis. So that's what a prepaid expense is. Investments come next. Those are long-term commitments of funds, at least 1 year or more. So if the company owns stocks or bonds of other corporations, basically we plan on holding them for long term, they essentially will be considered a long-term asset. There are exceptions. If you are basically trading frequently and just looking to make quick profits, some of those investments can be classified as current. Then we go down to plant and equipment. Plant and equipment is basically our buildings, office buildings, factories, warehouses, and so on that we work in. And obviously they're long-term. They don't turn into cash unless we sell them or liquidate them, which is not the intended use of those assets. Those assets basically get depreciated over time, and they get accumulated as depreciation. So here's a balance sheet. Assets, current assets are listed first. We have cash, marketable securities, accounts receivable, less allowance for bad debt, inventory, prepaids, equal total current asset. It is this section which is liquidity for our company. These are the assets that will turn into cash, generate cash over a short period, less than a year. Other assets, investments, and then we have our fixed assets, plant, equipment, less depreciation. We show our fixed asset at net book value. Net book value is the original cost less accumulated depreciation. So we get a net plant and equipment amount equals total assets. So liquidity, the most liquid starts at the top. The further you go down the asset list, the less liquid these assets are. And then we go to our liabilities and stockholder equity, starting with our current liabilities. Current liabilities like accounts payable, note payable, accrued expenses, and any long-term liabilities that are due within a year would be classified as current liabilities. Again, current meaning our obligation is to pay these items in 1 year or less. So the 1 year rule is very important for classifying liabilities. As our obligation or debt is due further and further beyond the year, they become long-term liabilities, which include bonds payable. Stockholder equity consists of preferred stock, which gets ranked ahead of common because preferred stock has liquidation rights. If a company goes bankrupt and liquidates, it has to pay its debt obligations first. Then the pecking order is preferred stockholders will get what's left over, and if there's anything left over after that, common stockholders get what's left. Also, preferred stockholders, if there is a dividend policy, have a right to dividends before the common stockholders. Capital paid in excess of common stock is simply an accounting transaction. Common stock will be issued at par, but in the market, common stock basically fetches what the market will bear. So if the par value is $1, but the investor is willing to pay $10 a share for an IPO, the difference, $9 minus the par value of 1, goes into capital paid in excess of par. Then we have retained earnings, which is really all the net income less dividends that accumulate in over the years, equals stockholder equity. So if you remember, stockholder liabilities and stockholder equity have to equal assets. So total assets minus liabilities equals stockholder equity. Or total assets equals total liabilities plus stockholder equity. Interpreting the balance sheet, total assets are financed through liabilities or equity. Liabilities represent financial obligations of the firm. They could be short-term or current, like accounts payable that we owe to vendors, or they could be a longer-term, like bonds payable, which are essentially a contract, a guaranteed contract to pay interest to the bondholders, the debtors. Move from current liabilities due within 1 year to longer-term liabilities. Again, liabilities and assets are a measure as well of liquidity. Our ability to pay our debt and liabilities is extremely important. Short-term obligations, accounts payable, represents amounts owed to vendors, notes payable, short-term obligations to bankers. Accrued expense is generated when services has been provided and payment has not yet been received. An accrued expense would be at the end of the month. You have 3 days of payroll unpaid in that month that gets paid in the following week, which is the next month. So essentially, cash paid to employees for wages gets paid in the following month, but 3 days left in the month you would have to accrue 3/5 of a week in the month you're producing the financial statement. That would be considered an accrued expense. Stockholders' equity represents total contribution, ownership, interest of preferred and common stockholders. What is the concept of net worth? Net worth, or book value, you'll hear that a lot, is stockholders' equity minus preferred stock component. So the stockholders' equity, net worth, is really assets minus liabilities. So net worth equals assets minus liabilities which equals stockholder equity. And that's where this slide just starts out with stockholder equity, but it's really assets minus liability. If you go back to our balance sheet, assets 1 million minus liabilities of 300 equals the stockholder equity of 700 right here. So assets minus liabilities equals net worth. But why do the calculation when all you have to do is look at the stockholder equity, which is the difference anyway? So back to the concept of net worth. Net worth is stockholders' equity minus preferred stock component. So you would take the 700,000 on the balance sheet, right here, and you would subtract 50,000 of preferred stock to get to 650,000 as the net worth. So getting back to our net worth, which can't seem to find. So back to the concept of net worth, stockholders' equity minus preferred stock. Market value is of primary concern to a financial manager, a security analyst, and stockholders. Market value, unlike net worth, is what the market perceives the value of the company, and it may be reflected in the price of the company, whether it's publicly traded, you have stock prices that are valued at a per share basis, or the private equity market, meaning private investors investing in private companies also have to value companies. That's called market value. Like the income statement, the balance sheet has limitations. It's not perfect. Most values on a balance sheet are on a historical basis, not on a market value basis. Yet, company stock prices are supposed to represent the market value of what a company is worth based on a share price. So if we're evaluating every day the price of companies' share prices up and down every day, but yet we're making that decision looking at a financial statement that is using historical cost. So there seems to be a disconnect there. So that's one limitation of a balance sheet. Another limitation is factors explaining differences between per share values. Asset valuation, industry outlook, growth prospects, quality management, risk return expectation all influence how shares go up and down every day for these companies on the stock market. Take a look at this chart, which is interesting. The book value per share is essentially our net worth. It's the stockholder equity, i.e. assets minus liability equals stockholders' equity, with a slight adjustment for preferred stock, equals book value. You take that number and you divide it by the number of shares outstanding, and you get a book value per share. So from a balance sheet perspective, UPS is worth $6.19 a share based on their balance sheet, their net worth. Yet, the stock market investors are saying that the per share of UPS is worth $103.42. That ratio of 103.42 divided by 6.19, in other words, the ratio of the market value divided by the book value, is 16.71 times. So investors are willing to pay a multiple of 16.71 times UPS's book value. Verizon, they were willing to pay almost 12 times the book value. IBM, almost 11 times. Kellogg, just 7 times. So Kellogg, investors are saying his book value is worth about 7 times on the market. PepsiCo is down at 6.41. Apple, which is an innovative technology company, looks cheap compared to UPS. Apple is book value is multiple is only 5.91 times. Adobe, Microsoft, Oracle also look relatively cheap. So the lower this ratio, what it's saying is, the market is saying that the company is worth on the market closer to what the balance sheet is telling us. And you'll find that companies, when they have a bad year on earnings, expectations will drop tremendously. And therefore, this ratio can go from a high to a low fairly quickly. This company, Comstock Resources, is basically paying at less than book value. Investors are saying the company is worth less than the book value of the balance sheet. Statement of cash flows. Again, a very underappreciated statement. Rather difficult to prepare from an accounting standpoint. It's not very intuitive. But what it does is it emphasizes critical nature of cash flow to the firm's operations. How we convert cash within 90 days allows matching of revenues and expenses in a period in which they occur. The cash flow statement is essentially telling us how well we manage cash, generate cash, and what we did with that cash. So how did we go from $1 million in cash in the beginning of the month to $500,000 of cash at the end of the month? By looking at our income statement and balance sheet, the transactions between the two will tell us that story. Disadvantage of the statement of cash flow. Adequate attention not directed to the firm's actual cash flow position. Cash flow analysis helps in combating discrepancies faced through the accrual method of accounting. So the accrual method of accounting, which is reflected in our income statement, is not really a cash basis. So we have to go through a lot of work to convert our income statement and balance sheet into a cash basis system so that we can show how our cash was generated. Developing an actual cash flow statement gives us 3 areas of cash flow. Cash flow from operating activities, which is basically our income statement generating net income, and it changes in current assets and current liabilities, because we use our current assets, such as receivables and inventory, and our current liabilities, which is essentially our vendors and short-term debt that we use to finance our operations. The current assets and current liabilities are essentially used in operations. So the changes in those two, up or down, and changes in our net income from our income statement will generate operating activities. Cash flow from investing activities. Did we buy equipment long-term that's going to be depreciated over a long period of time? Did we buy factory equipment and so on? That's considered an investment in the firm and an investment from a cash flow standpoint. And then we have cash flow from financing activities. Financing activities will be, did we raise cash by issuing stock? Did we reduce our stock by buying back stock called treasury stock? Did we issue dividends to shareholders? Did we pay long-term debt to bondholders and long-term debt to bankers and so on? That would fall under financing activities. Combining all 3 of these, operating, investing, and financing activities, generates net cash flow or net change in cash flow. So cash flow from activities plus cash flow from investing activities plus cash flow from financing activities will equal a net increase or decrease in cash flow. And here's a quick description of what goes into operating activities, investing activities, and financing activities. Determining cash flows from operating activities, we translate of income from operations to an accrual to a cash basis. Most companies will use the indirect method. The direct method, because we use accrual accounting, is not almost impossible with most accounting systems today. So we use an indirect method, which basically looks at the changes of our balance sheet accounts. To generate net cash flow, we take our net income, we add back depreciation because depreciation is a non-cash expense. We look at the increase or decrease in our current assets, increase or decrease in our current liabilities. That equals net cash flow from operating activities. So determine cash flow from operating activities. You start with net income from the income statement. You add back depreciation because it's a non-cash deduction. You look at the increases or decreases in your current assets because those are the assets that are used to generate cash in less than a year. You recognize the increase or decreases in current liabilities to get cash flow from operating activities. And that basically all comes from your balance sheet. And this slide will show you where the net income came back, add back depreciation, increase in accounts receivable. Well, increase in accounts receivable is a reduction of cash. We'll explain that in class a little further. An increase in inventory is a deduction in cash because we basically bought inventory, so we tied cash up in that. Increase in accounts receivable deduction in cash is because our sales, we generated more sales, which generates more accounts receivable for that time being. In other words, the customers haven't paid us cash yet. Yet, we started with net income. So the net income has has sales that have not been sold, turned into cash yet. We have to wait for those receivables to be paid. Decrease in prepaid expenses. Basically, we had expenses that reduced our net income, but we prepaid it, so it gets adjusted and added back. The good news in finance is we don't have to create or do the cash flow statements. That's what accounting is for. We have to interpret them and analyze them and figure out what's going on in the company. Again, we get to tell the story instead of write it. Cash flows and investing activities, straightforward. It's long-term investment activities in plant and equipment. It's the use of funds and source of funds. And then determining cash flow from financing activities, which will be applying to the sale or retirement of bonds, common stock. Sale of a firm's securities is a source of funds. Payment of dividend and repurchase of stocks are a use of funds. Combining the three sections of the statement, we basically add them up and we come to net cash flow. Depreciation effect on funds flow. Depreciation is a non-cash expense. It's not really a source of funds, but it gets added back to net income to determine the amount of actual funds on hand. Because, if you remember in our income statement, net income was derived by deducting depreciation as an expense. So net income was lower because of depreciation. If we start with net income as an operating cash flow, okay, and we have non-cash expenses that reduce that net income, we essentially have to gross up the net income for non-cash expenses. Depreciation is the typical non-cash expense that grosses up net income. Here's a comparison of accounting and cash flows, and basically shows earnings before depreciation, less depreciation gives us earnings before taxes. And so on. So to get to cash flow, earnings before depreciation is $1,000. Less depreciation gives us $900. We have to add that depreciation back to get to our cash flow. That's all that's showing us. Free cash flow, an important metric that we'll be studying and analyzing. Free cash flow is cash flow from operating activities minus capital expenditures. So it's capital expenditures basically on plant and equipment minus dividends gives us free cash flow. You'll see many financial analysis will show free cash flow per share. Analysts will take free cash flow and then divide it by the shares outstanding to get a free cash flow per share. Corporate taxes, again, they're very complex, but what you need to know is in most of the problems in the of analysis that we will do, corporate tax rates come into play. And the reason they come into play in this class is because many times we will have to determine what cash flow is being generated from an internal project. When we do discount cash flow analysis and capital budgeting, we're going to have to figure out the cash flow. And sometimes the expenses, because expenses reduce our income. Essentially, our income reduces our taxes by having lower net income. Therefore, the tax rate that expense helps reduce comes into play in figuring out cash flow. The depreciation is also a tax shield, which will help improve cash flow because we pay less taxes on our net income, which was reduced by depreciation. So that's a quick accelerated slideshow. But what I'd like to do is show you some income statements for Costco, which we all know and probably frequent. And so Costco's income statement, this is from 012 to 013 to 014 to 016. TTM means trailing 12 months. So basically is forward-looking. Trailing 12 months means the current period's in now over a 12-month period. So as you can see, Costco's revenue is growing quite nicely each year, and its gross profit is growing quite nicely each year as well. Gross profit as a percent of revenue, we're going to be doing a lot of that calculation, but this will do it for you. Right now, gross profit started out in 012 at 12.42% of revenue. It's now 13.32% in 016. So gross profit is improving a little bit at Costco, which means it's earning more dollars on each sale. That's something you want to look for in your company when you analyze the statements. Or if you're looking to invest, it's something you look for. Back to dollars. Next, we have operating expenses, which is a summary of all the sales, general, and admin. You can see that's also growing. But the important part is it growing faster than the gross profit? Which it is not. So as the gross profit is growing at a faster rate than the sales G&A, okay, we will produce more operating income, which Costco has shown throughout the years. Getting down to net income, Costco has also been growing their net income steadily. And then earnings per share, basic and diluted. Basic is straight net income divided by number of shares outstanding. Diluted takes the basic earnings per share and it adjusts the number of shares. It adjusts the number of shares by convertible bonds and things that can be converted into shares, but that's for another course. So its earnings per share has been growing steadily. The balance sheet. Again, over a 5-year period. Current assets are listed first because of liquidity. What generates cash in 1 year or less by liquidity. Cash is the most liquid asset. Short-term investments. These are probably 1-month CDs or short-term commercial paper. Then we have receivables, inventories, deferred income tax, other, to get to total current asset. Then we go to our non-current assets. These assets do not generate cash over a short period of time. Land that Costco owns, fixtures and equipment, properties, and so on. Less accumulated depreciation. We want to show our fixed assets or property plant at net value, book value. Total assets. To liabilities, again, we have current liabilities, short-term debt, accounts payable, money we owe to vendors for 30 days or less, taxes payable, accrued liabilities, and so on are current. Then we have a long-term debt. The more complex accounting transactions such as minority interest. Stockholders' equity starts with our common stock, additional paid-in capital, our retained earnings, less accumulated other comprehensive income, which is going to be dividends paid out, goes into that category, treasury stock, and so on. So total assets have to equal total liabilities and stockholder equity, which they do. And then taking a look at our cash flow statement, let's see how Costco generates stock. Obviously, it has a nice big net income to start with. It adds back its depreciation. It takes the changes in its accounts payable, other working capital like receivables and so on. As you can see, its net cash provided by operations is a pretty big number every year. So the company generates cash from operations. How did it spend that cash? Well, invested in property. It purchased investments, so it took some of the liquidity excess that it had and it bought investments. It sold some of those investments as well, and so on. So net cash used for investments. Cash flow from financings. It had short-term borrowing. It paid. It issued and repaid debt. It purchased stock, its own stock, okay, in the market. We'll learn about why companies do that. It paid out dividends. and other financing activity, which is probably debt related. So net change in cash year to year, it's been going down. Cash at the beginning less net change in cash equals cash at the end. So it seems to fluctuate. Free cash flow, what we learned about in our slide, PowerPoint. Operating cash flow, which it takes from here, and it subtracts capital expenditures, which is in property. It uses just this line, and it gets free cash flow. So that's a quick example of income statement, balance sheet, and cash flow statements. Morningstar is a good website that I sent to you in an announcement. I suggest go into it. You don't have to join it, and you have access to a tremendous financial information, financial statements all laid out for you like I showed you. Key ratios, we'll be doing a lot of ratios in this class, and you'll see ratios like gross margin ratio. You'll see that Costco has basically been steady, slightly ticking up, which is a good trend. Operating margin ratio, also, how much profits we're earning on our sales has been trending up. And we're going to learn about profitability ratios. Very important is our return on assets, financial leverage. We're going to learn how companies use debt to create wealth. They actually borrow money to generate higher returns for their investors, if they use that money wisely, of course. And that's where capital budgeting comes into play, and so on. Return on equity, return on invested capital, important ratios that we will use. Again, it's taking income statement information and balance sheet statement information and creating ratios. Basically, how well companies utilize capital and equity to generate a return for their investors. So that pretty much wraps up this lecture. We'll be going over this carefully in class, and we'll be looking at lots of examples and doing some light interpretation, so you get your feel around these statements. We'll get deeper into the statements with ratios in the following week, and we'll learn about how to generate returns on investment to shareholders as financial managers of firms. We'll be learning about how to do that, how to measure it. So enjoy the class this Saturday, and see you this week. Thanks.